Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, July 2nd, 2018. We're looking at a daily chart of the SPY, or Spiders, which is the proxy for the S&P 500. What I'd like to do right now is do a slight recap of where we were last week, what we've discussed, and what to expect this week and beyond. If you recall, we've been discussing the line in the sand, which is really a daily close above this particular candle right here. That represents the 27th of June. Any daily close above that level is going to turn the market, at minimum on a short-term basis, back in the bullish camp. We challenged that level on Friday. However, we did fail and finished near the lows or on the lows on Friday. There was actually a failure late in the day leading into the close on Friday. And at least from last week's perspective, Friday's perspective, that shows you the importance of this level up here. The market was not able to even get up to nor through that particular price level. That remains a line in the sand. The number that we're using for the line in the sand is a close above 273.87. That's based on the daily chart. If we cannot get through that number on the upside, you can see what's developing here. What we have is the makings of a bearish pattern, or it's actually a little bit more than the makings of a bearish pattern. We've had a down move, and we're putting in somewhat of a bearish flag pattern, bearish wedge pattern, call it what you will. This is generally going to result in another move to the downside. Now, what I've been saying is, until and unless that we can confirm, meaning we can get above this particular level of 273.87 and close above that level on the daily chart, then we're likely to see lower prices until and unless that happens. So the pressure will remain to the downside until we can close above the high from the 27th of June. Now let's discuss where we are in terms of this week. This week on Wednesday, we have in the US the 4th of July holiday, and that splits up the week. And what that does to the volume and the market participants is it really takes them out of the mix. So for example, you're likely to see very, very light volume. Tomorrow, by the way, is half a day. So Tuesday, trading will cut off. I think it is 1 o'clock p.m. Eastern Standard Time, and it will resume in the cash market on Thursday. The futures will open up Tuesday night at 6 o'clock after closing in the afternoon, and then they will trade through, I believe, halfway into Wednesday. Why they do that, I have no idea. But what we have to be concerned with is the fact that there's a holiday and therefore volume is light, so I'm not sure there's going to be a lot of upside to be had or a lot of downside to be had for the remainder of this week. However, what I will say is I thought that this morning and we woke up and the market was trading down and it looked like we could see some more downside in the market. However, as you can see, we gapped down, started lower, and had a recovery, and we're going to go over this in a second. This is the intraday 10-minute chart, but you can see here that we gapped down, so this was the close from Friday. This is the poor close on Friday, and you can see what happened at the end of the day. They really hit the market hard, so we gapped lower today and immediately reversed. We went up. And what happened was we made a higher low. And when we see a higher low, that's generally speaking an indication that the lows are in for the day, and that did turn out to be the case. Now, they had a little bit of a fake out or a try at a fake out, and then you can see they took off to the upside into the moving averages, pulled back, and then busted through them at the end of the day. And that has a lot to do with, in my opinion, the holiday week, the lighter volume, and in light volume markets, the path of least resistance is generally going to be to the upside. That happens more often than not. It's not an absolute. It doesn't have to be that way. It just happens to be that way the majority of the time. By the way, let me pause here for a second and thank everybody for participating with posting comments under these videos. Get the interaction going. I love the interaction. Please keep the comments coming. I'm happy to answer questions. It's helpful to everybody in the community, so please keep it up. In addition, please hit the like button on the video and also share the video with somebody that you think can benefit from this information. I thank everybody for being here and participating and being part of the community. Now, I think there is something that's worth mentioning on the intraday 10-minute chart, and there's actually a number of areas that are worth mentioning because for our intraday traders, there were a number of trades to be found today. And for those traders that have taken the course at Lazy E-mini Trader, you'll see that the market went up for a specific period of time, and it basically came up in to fill the gap. It came up slightly short of the gap, but being that it was for a specific period of time, almost into the gap, if anybody that was willing to front run the gap a little bit would have done so and been rewarded accordingly. But even without taking a trade, you can see how time is more important than price. When the market moves, changes direction or changes trend and moves for a specific period of time, you're likely to get a trend change. We like to see a signal or sign of a reversal or trend change. We didn't necessarily see that, but what you can see is the market traded right up into that gap area and then pulled back and made that higher low. When the market made the higher low, the question is, was there a trade in there somewhere, or where was the trade? Well, theoretically, you wouldn't have taken a trade, at least I wouldn't have taken a trade, up until the point in which we closed above the high of this candle from the morning session. That came in right at 271.01, came in at 271.07, and then what you'll notice is we actually closed above that level right here. So the high of, or the close, of that candle was 271.17. That's the tip-off that the market is likely pushing higher. But look at what they do. Immediately pull back, and that's to trick, trap, and fool as many traders and investors as possible, thinking that they put in another high and the market was going to sell off again. That wasn't the case. They did a little pullback for about 40 minutes, and then you can see into the end of the day, took off to the upside. However, the key here that I want to point out, and you can use this type of information on any chart, whether it's an intraday 10-minute chart, an hourly chart, daily, weekly, and so on. Any chart or all charts act and react the same way. So what you'll notice is the tip-off is when they closed above the high of this particular candle. That was the tip-off that higher prices were likely into the end of the day. Is it an absolute? Absolutely not. Does it work the majority of the time? Yes, it does. Here's an hourly chart, and the other thing I want to point out is with the holiday in the middle of the week, likely story is we have light volume throughout the remainder of the week. So the question is, can we push up higher? And the answer is we absolutely can. We can certainly fill this gap, which would coincide with the convergence of the 100 period moving average and the 200 period moving average right above price and below the gap fill area. And just to keep in mind, we're going to go back to the daily chart one more time. Keep in mind, if we did close above the high from the 27th, 273.87, that would be a bullish sign, and that would be a sign of higher prices to come. We would have to fight through the 20 period moving average up here at 275, but keep in mind, unless and until we close above this high from the 27th, then we can fill the gap and still close and finish below that level for the day. That's just something to watch out for. If the market continues to push up and we do go fill that gap based on light volume activity in the markets, then the most important thing that you need to be aware of is the closing price for the day. On the downside, 265.50 remains an important number. If the market should begin to trade lower, that's where I believe we'll find support right around 265, 265 and a half, 266. In that neighborhood is where the market would likely go if, in fact, this bearish flag pattern that's developing were to play out to the downside. We could certainly go lower, but right now, this is where I think we would find a very, very high level of support. The IWM, my favorite market leading indicator both on the up and the downside, you can see what's developing here. What seems to be is we can trade all the way up to the top of this particular breakdown candle from the 27th. That's the same day we just discussed on the spider chart. We can trade all the way up to that. It happens to coincide with the 20-period moving average. However, we can trade up to and challenge the high of the breakdown candle and still remain essentially in a bearish pattern, a bearish wedge pattern, that if the market decides to sell will certainly produce lower prices across the board, the IWM included. Now the transports, my second favorite market leading indicator. So the transports are interesting. We had this tail candle from the 28th of June, which is last Thursday, and so far this tail candle is holding. Getting below the low of that tail candle on a closing basis would be very negative for the transports. However, I want to point something out that I find interesting / fascinating. So look where this tail candle went to. In order to do that, just focus on this level right here. The tail candle, bottom, close to the bottom, it doesn't really matter. What my point is that we had another tail candle that actually resulted in a very, very strong rally in the transports, and that was right here. After that tail candle was made, we did a retracement of that tail candle before taking off to the upside. Look where that is. Right where we came to on last Thursday's low, we came to the same level as that green or breakup candle low. So we tested the breakup candle low from a while ago. This happened to be all the way back from May 4th. That's where the market found support, and so far that level has been good. We originally talked about the transports getting down to around 10,150 level. You'll remember that from several of the other videos in the past. We actually made a low of 10,192 and change, so that's very, very close. We talked about the 10,150 long before price was even close to that level. The transports did find an semblance of support and therefore so far have taken off to the upside, but there's a lot of work to do on the upside. We have a 100-period moving average ahead of us or above us, as well as a 50 and a 20-period moving average. So the transports are no way out of the woods yet, but for now, with the transports finishing up 1% and the IWM finishing up 0.7%, my two favorite market leading indicators, at least from this point right now, are telling us from the short-term perspective, higher prices in the market are likely, and that coincides with the fact that it is a holiday week and we shouldn't be surprised to see higher prices throughout the remainder of this week. Looking at the XLF, up about 0.5% today. It represents 14 cents. Not a big deal one way or the other. The important thing that we want to note is we're below all the moving averages, and we are similar to the spiders, similar to the IWM. We're really making a bearish pattern, and we certainly can push higher in the financials, but when you look at this, you say, even if we push higher, how high do we have to get to turn this back to at least a short-term bullish stance? And in my view, we would really have to start pushing up to and through at minimum of the 20-period moving average, but we would really need to get through the 50 and the 200. They're converging right here. We would have to get through those and close above the high from the 20th to turn this market back to the bullish side. So the financials are not out of the woods yet. We can certainly still have another leg lower across the board. Again, this week is going to be a coin toss because of the light volume, the lack of participants in the market. We can see more downside this week. It just happens to be unlikely. Even though we saw the market fall this morning, it was almost like a sneak attack, and they reversed the market pretty strongly, finishing near the highs. That tells me we're unlikely to see a lot of downside remaining this week. Here are the triple Qs, representative of the Nasdaq market, the Nasdaq 100. And what we see here is, again, the same bearish pattern. We can have more upside. But what's interesting with this market, and this market is stronger than the spiders, this market is still trading above and hasn't yet closed below the 50-period moving average on the daily chart. When you take a look at the weekly chart, you'll notice that, technically speaking, there's nothing wrong with this market. We have yet to visit the 20-period moving average or home base based on the weekly chart. So while this market can go sideways, it can come lower somewhat. Technically speaking, no damage has been done to the triple Qs at all. We need to be aware of that. Even if we have some more short-term downside in the market, SPY or the S&P 500, Nasdaq included, either way, technically speaking, there's no long-term damage done to these markets just yet. And what we've been discussing is if the downside targets that we've been discussing on the SPY get tagged or touched or hit, 265.50 for example, or thereabouts, again, my expectation is we will find support at that area and we will have another leg higher. How high we don't have to worry about. Are we going to make new highs? We don't have to worry about that right now. We'll just take it one day at a time and we trade the market that's in front of us. Here's the SMH representative of the Philadelphia Semiconductor Index, which is a great proxy for the technology sector. Again, it looks like the other markets. It looks like it's developing a bearish pattern. So right here, you can see it's pretty obvious, staying consistent with how I view the markets. As long as we don't close a day above the high of this candle from the 27th, 104.32, this market will stay in a bearish stance with downside pressure until and unless we can close above the high from the 27th. We've also got to get above the convergence of the 100 period and the 50 period moving averages as well. And I think that gives us a pretty good view of where we are across the equity markets. Let's flip over to gold and take a look at what we have. And what you can see is we continue to melt away in gold. Remember, we talked about the 1250 to 1255 area. If that didn't hold, we would likely go all the way down to the 1230, 1235. Looks like that's where we're headed now. We came very close today. In fact, the low today happens to be 1240.60, so we're only a few dollars away from that secondary target of 1230 to 1235 on the top end. It's not a market I'm interested to be long right now, and you can't short a market in the hole. It's a fool's game. So what I'm going to do is just let it fall, let it find support, let gold put in a sign or a signal of a trend change, and we'll evaluate it at that particular point. Right now, there's nothing to do in the gold market. Now, let's go over and look at crude oil. We've had a tremendous move in crude oil. Crude was up again on Friday, peaking into the hot zone. The hot zone was north of $74 a barrel. Let's take a look at the weekly chart and we'll look at the hot zone. So $74 to $78 a barrel is the hot zone. My expectation is we get a little bit deeper into this area, at which time we're going to begin looking for signs and a signal of a trend change. That will be based on the daily chart first. I'm expecting for crude oil to get a little bit higher. I'm not going to be surprised to see it get up into the $75, $76 area, potentially even a little higher, but I'm going to wait for a sign and a signal of a trend change before doing anything. I think that particular price zone represents a stone cold short. It's not uncommon for crude oil to run up into the 4th of July holiday weekend or week. It sometimes happens on a weekend, but right now we've run up into the 4th of July holiday. Traders and investors expect that to take place. So it's one of those self-fulfilling prophecies. Everybody talks about the fact that it's a driving season. There's a lot of vacations being taken. The price of crude oil gets jacked up. The price of gas gets jacked up. And my expectation is that once we pass through the holiday week, a little bit of air is going to be taken out of this market. I'm not going to call it a bubble, just calling it a market. But I think in the middle of that hot zone, or even preferably towards the high of that hot zone, we'll be looking for signs and a signal of a trend change. And with that, folks, it's really everything I have and intended to discuss today, so I will give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.